Welcome everyone to WriterSpeak. WriterSpeak is dedicated to the written word and those who produce it. I'm your host, Jeane Slone. I am the author of 2 historical fictions, She Flew Bombers and She Built Ships During World War II. Today in the studio, I would like to welcome Bill Matson. Welcome, Bill.
Hey, thank you, Jeane.
It's nice to see you.
Likewise, likewise.
Bill has written a quite thorough book titled Data-Driven Investing. He has recently moved to Forestville, and his book includes 45 months of Bill's fidelity brokerage statements from a period when the S&P 500 lost 18% of its value, while Bill was making 788%, more than $3 million in gains. And during the course of its 500 plus pages, it analyzes in detail how he did it. Data-driven investing has earned praise from prominent Wall Street figures. Joe Moglia, the chairman of TD Ameritrade, one of America's largest discount stock brokerages, called it groundbreaking. In his own book entitled Coach Yourself to Success, Winning the Investment Game. Bill's career in finance spans over 35 years. A retired CPA, Bill also holds Chartered Financial Analyst, Certified Financial Planner, and Accredited Domestic Partner Advisor designations. He is a graduate of Babson College, where he received his BS in accounting with highest distinction, as well as of Harvard Business School, where he earned his MBA. Bill is currently on the board of advisors of the Admiral James J. Carey Foundation and serves as a membership vice president of the Harvard Club of San Francisco. Well, Bill, much of your book is based on your work with Compustar Database. Could you talk about that?
Sure, I'd love to, Jeane. Basically what the Compustar Database is and does is it contains literally tens of millions of data points on tens of thousands of stocks that have traded in the U.S. Since 1951. And it includes not only data on stock prices and trading information, but also financial statement data. And what we did was lease this database. It went for about $35,000 a year 10 years ago. And we leased it for 2 years, and I hired a very talented programmer who worked with me to identify patterns in stock returns and also financial statement attributes to see what sort of things might be predictive of either superior stock returns and as well as things that would be predictive of very bad stock returns. And this was really the starting point for me creating the decision rules that guide my trading to this day.
Now tell me, why do you believe that small companies are better bets than larger ones?
Well, based on our work with the Compustar Database, one thing that was very, very clear is that as companies get bigger, their returns on average tend to fall very consistently and predictably. And in fact, I jotted down a few numbers here. One thing we found was that if you took a portfolio of the 100 largest stocks in terms of their market value, and basically adjusted that portfolio at the end of each year so that you would always have the 100 largest companies. During that period from the end of 1951 to the end of 2002, each dollar would have grown to $148, which doesn't sound terrible. That works out to about a 10.1% compounded return. However, if you lower the threshold of market value that you're looking at to the point where what we took were the 100 smallest companies with a market value greater than $10 million in 2002 inflation-adjusted dollars. So 100 smallest companies that are still over 10 million in market value, the return on that would have been each dollar growing to $4,418, which is actually a compounded rate of return of 17.5% rather than 10.1. Now, what we also saw was that raising that threshold consistently lowered the returns. If we set it at 100 million and take the 100 companies just larger than that, the compounded return goes down to 14.8%. It goes down to 13.3% once you get up to 250 million. It goes to 11.6 at a billion, and as I said before, the 100 largest were 10.1. The reasons for that are, first of all, that most investors like to invest in companies that they know. They get some degree of comfort from doing that, and consequently, they wind up paying a premium for that comfort, which lowers the returns that they're able to achieve. Another reason that they tend to overvalue, at least relative to smaller companies, the stocks of those big companies, is that there's a lot of volatility associated with the prices of small companies. And a lot of investors just don't have the stomach for that. However, the thing that we do is we believe that there are two types of risk. There's company-specific risk and there's market risk. And what one can do to basically diversify away the effect of company-specific risk is to own lots and lots of stocks. So for instance, I own dozens and dozens of small companies, so that if, for instance, an airline that I own is hurt by oil prices going up, an oil exploration company that I might also own will do well. So these things tend to cancel each other out, leaving us with market risk, which can be addressed by either selling short or buying put options on companies that are likely to have subpar returns. And also I buy some put options on the S&P 500 index. And so in that way I address both company-specific and market risk.
I know that you like companies that most people would consider boring.
That I do.
So tell me, Bill, what is that about?
Well, what I find is that boring companies tend to be very good values in terms of their price to sales, their price to earnings, and their price to book value ratios.
Could you give me an example?
Though we saw that there was a big relationship, a correlation, if you will, between company size and returns, that correlation is even more pronounced when you go from growth to value type stocks. And as a for instance, if one was to take the 100 largest, or not 100 largest, but 100 highest price to sales ratio stocks and have a portfolio that every year reconstructed so that you were always owning the 100 highest price to sales stocks, that portfolio gave a compounded return of 0.4% over that period from 1952 to 2002. meaning that if you invested $1 in this portfolio, it would be worth $1.20, 50 years later. In contrast, if one were to buy the 100 lowest price to sales ratio stocks, every dollar would have grown to $705,068, which represents a 21.1% compounded return. Which it seems as though for that kind of cumulative impact over the years that it would be an awful lot higher annual return. But basically, when you have money working that long, even small differences in the percentage returns make a big difference. And kind of reminds me of something that Albert Einstein once said when asked what he believed to be the most powerful force in the universe. Would you happen to know this?
A tornado?
Too long. You lose.
Too long. I was trying. I could only think tornado.
No, Einstein's answer was compound interest.
Well,
and
I wouldn't have guessed that.
Yeah, it's just so important. Assuming that you expect to have a significant length of time left in your life, to make a few extra percent by going into situations where the odds are in your favor.
Now, your book, Data Driven Investment, coins a quite original term, Fed election cycle. And you discuss its importance at length. Could you tell our viewers what is that and why is it so important for investors to be aware of?
Okay. Taking the effect of Fed activity and the election cycle separately to start with, one thing we also found when we examined stock returns in relation to what the Fed was doing is that when the Fed is attempting to stimulate the economy by being less restrictive with their monetary policy, stocks tend to do very well, as they have been doing during this most recent period of Fed stimulus. And we've also found that when we encounter inflation and the Fed starts to tighten up on monetary policy to slow down the economy, that stocks tend to not do very well. And the numbers on this were that when the average Fed funds rate, which is the overnight lending rate that banks charge each other, rose 1% or more from the previous year end, the S&P 500 averaged only a 2.3% return. So that is to say, when Fed funds goes up by 1% for the year, 2.3% return, versus when it declined 1% or more, the return was 17.3%. So huge difference. Now, taking a look at the election cycle, what we found is that stocks tend to do much better during years 3 and 4 of a presidential term than during years 1 and 2. And there's definitely more political motivation to stimulate the economy as those presidential election years approach, because in fact there's a fairly long history of presidents and their parties being voted out of office when in fact the years leading up to the election aren't good for the stock market. And we saw that most recently in 2007 and 2008. Certainly the election would have been a lot closer, and perhaps John McCain might have won had the economy not crashed and taken the stock market down with it. The numbers on this are that the 100 largest companies between 1952 and 2002, on average during years 1 and 2 of the election cycle, they were up an average of 6.6% versus 16.1% in years 3 and 4. taking a look at the very small companies just above 10 million in market value, they were up on average 11.7% in years 1 and 2, but 33.8% on average in each of years 3 and 4. And when you put the effects of this together into what we call the Fed election cycle, what we saw was that early election cycle and aggressively restrictive Fed years had average returns of minus 3.8%, while late election cycle and aggressively expansive Fed years had 30.2% average returns. And as I say, past performance doesn't guarantee future performance, and anyone who went blindly into the market in 2007, 2008, expecting these results would have been disappointed. We're broke by now, but in general, the lesson to be learned there is that other things being equal, if you've got the Fed and the White House seeking to stimulate the economy, that's a good time to be in stocks.
I've heard a little bit that politics does affect financial situations, but it was interesting to hear you actually cite figures as to that it really does.
Oh, thank you. Thank you. Yeah, and incidentally, this, I'm not the inventor of this election cycle theory, if you will.
Yeah, I've heard of it, but to hear you give the figures really shows it to you.
I only went back into around 1950, but this phenomenon dates all the way back into, I've seen the figures going back into the 1830s, I think, back to the time of William Henry Harrison.
Oh, wow.
And there are similar effects that have been noted internationally with other companies or other countries surrounding their election years.
Mm-hmm. And in your book, you write about the shortcomings of generally accepted accounting principles that create opportunities for investors. Could you talk about this now?
Yeah, I'd love to. There are 3 areas in particular that I think are interesting here. First of all, generally accepted accounting principles dictates that land be carried on the financial statements and the balance sheet at its historical cost. So even if you've got land that may have been bought 100 years ago that's gone up 1,000 times in value, it will still be shown on the balance sheet at that historical cost from 100 years ago. Another thing where the accounting figures don't necessarily reflect economic reality is in the case of depreciation. Some assets, like buildings, for instance, are depreciated, and over time their value in accounting terms gets written down to 0, even though the value of these buildings may actually have been going up over time. And the third area of interest is with pension accounting, where 2 companies that are absolutely alike in every respect, except for the assumptions made regarding their pension expense, can have drastically different income and balance sheet figures. Because, for instance, a company can lower its short-term pension expense by raising its assumption for investment returns in the future, or lowering its assumption as far as employee compensation, or raising its assumptions as far as employee turnover. So basically, somebody who goes into the 10K reports of these companies with an eye toward seeing stuff where the accounting figures don't match up with economic reality is really in a position to exploit that in some cases.
In your book, Data-Driven Investment, you write about psychological phenomena causing stocks to be mispriced. How does this happen?
Well, the most common way this happens is that people have a tendency to want to sell their winners and lock in their profits. And at the same time, they've got a tendency to not want to face the fact that they've lost money on their stocks. So they will hold on to stocks longer than they should. And even sometimes if the stock goes from 10 to 5, they will think, well, I liked it at 10, I ought to love it at 5, and they'll buy more at 5. Basically creating demand for the stock for reasons other than the underlying fundamentals of the company involved. So anytime there's any sort of trading that occurs for reasons other than a well-researched, rational analysis of a company's value, that will tend to create a mispricing and an opportunity for someone to take advantage of it. Another phenomenon called anchoring causes the history of a stock price to unduly impact what people are willing to pay for that stock in the future. For instance, a stock that's trading at 10 may come out with a report that would really justify a stock price of 15, but more likely than not, the stock isn't going to open at 15 the next day. More likely than not, it's going to take a while for that stock to reach the level where it should be, just because people feel strange putting in an order to buy a stock for 50% more than it was trading at the day before.
I love this interesting term that you coined in your book, the Sergey Bubka Gambit.
Sergey Bubka.
Sergey, I have to get the accent right. Why don't you say it once more for us?
Yes, the Sergey Bubka Gambit, it named in honor of the greatest pole vaulter who ever lived. And Sergey set the records, both indoor and outdoor, for the pole vault back in 1994. But yet we'll never know how good Sergey really was, because he had to deal with his sponsors that said that he would get paid a pretty hefty bonus every time he broke the world record in the pole vault. There was no one even remotely nearly as good as Sergey. So what he would do is he would pole vault just high enough to win the competition, and then he would have the bar set at 1 centimeter above his previous record.
Oh.
And he broke the world record in the pole vault, the indoor and the outdoor records, more than 30 times over the course of his career. Now, how this is relevant to Wall Street is that if an analyst raises an earnings estimate on a stock, and he or she is right, they get credit. Mm-hmm. That's the important thing, to have made the call in the right direction. Now, if a company is, or if the consensus estimate for a company's earnings is $1 for next quarter, and we've got an analyst who feels very strongly that the number is actually going to be $1.50, more likely than not, he's not going to raise his estimate all the way to $1.50, because if the company only makes $1.30, then he looks bad, or she looks bad. So more likely than not, what will happen is the estimate will get raised to $1.10, and all the brokers in the firm will get on the phone with their clients and tell them that the estimate's been raised. So the firm makes just as much money if it goes to $1.10 as if it goes to $1.50. And also, it's a lower risk strategy for that analyst who makes estimates $1.10 when the number should be $1.50. The implication for the investor is that the market is more likely than not believing, or a large segment is believing, that $1.10 is a realistic, or the most realistic, objective, honest estimate available. And so it makes sense to buy when an earnings estimate is raised, and also sell when it's lowered. if perhaps the analyst thinks the number is going to be 50 cents, there's a tendency not to go all the way down to 50 cents, just to go down to 90. But then when the number turns out to be 50, you don't want to be in that stock.
Well, that's a good term, and you still have yet another phrase that you coined, and it's the shopkeeper trade. What are shopkeeper trades, and how can small investors make money with them?
Well, in essence, an investor who does a shopkeeper trade is making a market unofficially in the stock. Market maker sounds like a term that requires one to be a professional and have a big portfolio and firm backing up the activity. But in fact, the way it works is, and I'll give you an example. I've got one company whose stock symbol is ASOE, and not too long ago they were trading at 25 cents bid, 50 cents asked. Okay, and that's really analogous to buying wholesale and selling retail. If you can buy it down toward the bid price of 25 cents and selling toward the upper end. Mm-hmm. And if you think of yourself as a shopkeeper, what you can do is go put in your bid for 1,000 or however many shares at 26 or 27 cents on this thing that has a bid of 25 cents. And chances are good that at some point somebody who's in a hurry to get out of the stock is going to sell it to you. And if you're the best bid at 27 cents and they're not specifying that they want a higher lit price, you will wind up owning that stock. And what I very often do is buy a stock like that, and then I'll put in another order at 27 cents, but I'll also put in a sell order at 48 cents. And even if the company really goes nowhere, the stock may still be bouncing back and forth between over-anxious sellers mm-hmm. who are selling it to me for 27 and over-anxious buyers that are paying me 48. And so I'm kind of a shopkeeper there.
Yeah, that's an excellent analogy.
Well, thank you.
Well, you were last interviewed on WriterSpeak on October 19th.
I remember it well.
Yeah, and you told our audience about a stock called Astrotech. The symbol is ASTC. Mm-hmm. And it closed the previous day at $1.22. So I noticed that it closed yesterday on November 15th at $1.55. So now that we have seen you tell us about a great stock, can you give us another stock tip? A good stock tip?
Let's see. I should say, first of all, they don't all turn out that well for me. I don't always,
we witnessed that.
I don't always get a 25% return in a month, and again, they always say past performance, no guarantee of future performance. But just to tell you a little bit more about Advantage Technologies Group, okay?
That boring name.
A boring name.
Has to have a boring name.
Yeah, and they distribute and service equipment for the cable TV mm-hmm. industry, and I feel myself nodding off already, which is a sign that I'm on the right track. And as I mentioned on my last visit, I look for three things. I look for small companies, I look for value, and I look for a stream of good news coming from the company. And Advantage, symbol AEY, right now is, in terms of its value metrics, they're trading at roughly a 30% discount to their book value. Their price earnings multiple is around 16, and their price to sales ratio is well under 1. So good value. Their market value is around $26 million, so they meet my small company criteria. And the other thing is that they've just been constantly, even though they're still a good value, their stock price has been going up consistently on good news for the past year. They're up over 30% in the last 12 months, and right now they're very close to their 52-week high. So for all those reasons, I think that I certainly wouldn't bet the farm on AEY, but I think it has definitely has a place in a small company value portfolio.
Bill, you've done a lot of interesting things in your career. I'm really curious as to what plans you have for the future.
Well, what I'm doing right now is trying to line up a situation where I would work full-time for just a single, very wealthy family. I think probably somebody with in the neighborhood of $50 million of investable assets or more would be a lot better off paying me a salary and a little bit of a bonus to manage their finances. That'll probably take me a little bit of time to line up. So in the meantime, I'm trading my own account. And also I'm involved with a startup company called brainfutures.com, which will be involved in facilitating angel investments in entrepreneurs, and actually even pre-entrepreneurs, people that are still in college or recent graduates where the business is just really a gleam in their eye at this point. And actually I'm also working on a book on that subject that hopefully we'll be able to talk about at a future episode of WriterSpeak.
Yeah, well, let's hope it turns into a bestseller.
Oh, thank you, I hope.
Thank you for joining us on WriterSpeak, Bill.
Well, thanks for having me, I enjoyed it.
WriterSpeak is produced at C Media Labs. We would like to thank our sponsor, the Sonoma County Gazette. Please stay tuned next time for another episode of WriterSpeak with another talented author.